Hello boys and girls, my name is Rainer, and in this video post I'll share with you on how you can actually use the moving average indicator in a trending market. So we will be talking about how the moving average can act as a dynamic support and resistance, how it could shows you the direction of the trend so you can actually filter your trades to trade in the direction of the trend, as well as cover a little bit on relative strength on how you can actually use moving average to decide which particular product is the best product to trade in the trending markets. All that and more in this week's video. Okay, so first thing first, let's understand how the moving average can actually shows you what is the current direction of the trend of the time frame you're looking at. So say for example, in this chart, this is the weekly chart of euro dollar, and this red line over here, this is a 20 period moving average, and this is the 50 period moving average. And do understand, there is nothing magical about the 20 or 50 period moving average. Although I use them all the time, there's absolutely nothing magical about it. I use it because it fits my trading style, it fits my personality, and I do know how to use it and incorporate it into my trading plan. But however, if you go and backtest it, you go and trade it just solely on this moving average, you realize that there is absolutely no edge in the markets just by, trading this moving average crossover or buying whenever price touches the 50 EMA. There's absolutely no edge behind it. But I use it because I don't use it in isolation. I use it in context of the current trend, the current price action of the markets, and all this fits into my trading plan. So there's a disclaimer down there. So don't worry, that there's nothing magical about the 20 and 50. You can use 25 or 55, 30 or 40. It's entirely up to you. You can decide about that. So the main thing here I want to show you is that how we can actually use the moving average in identifying the current direction of the trend. And it's actually very simple. Alright, if I were to use structure of the market or to use the price action, I'll just look at the lower highs and lower lows in a downtrend, and higher highs and higher lows in an uptrend. But say for example, I don't want to read the market structure, I would just want to see the moving average, then what I'll do is very simple, just look at the slope of the moving average. So you can see the 20 here is clearly pointing towards the downside. The 50 here is clearly pointing towards the downside. And what it's telling you is that on this current time frame, which is the weekly chart, the path of least resistance right now for euro dollar is towards the downside. Right, so shorting opportunities would be favored compared to long opportunities based on this weekly time frame. Right, but if you look at, for example, say the 1 hour time frame, the 15 minutes time frame, that's where you may get conflicting direction of the trend. So what I'm focusing on right now is simply on the current time frame I'm looking at, which is the weekly chart right now, and it would favor shorts towards the downside because you just look at the direction of the slope, it's pointing downwards, pointing lower. So naturally, it's, I would say, instinctive to tell you that, the path of least resistance is towards the downside. So if you're trading based off the weekly chart, you will have higher odds or probability of success trading towards the downside. So don't get confused because I said that, euro dollar is better to short right now. But however, if you're an intraday trader, you're trading a 5-minute chart, a 15-minute chart, you may get a different story altogether. You may in fact want to go long, which is against the weekly chart time frame. So again, there is no right or wrong, but it's to rather understand the tools, understand the current time frame you are trading, and to make the best out of it. And we can go on and talk more about multiple time frame, etc. But there will be another video altogether in future. So basically what I try to say is that moving average, this is the first example on how you can actually use it to tell you the current direction of the trend at the time frame you're currently looking at. So the time frame I'm looking at is now the weekly chart. So next up, let's understand how the moving average can act as dynamic support and resistance. So the thing to know is this. Every time in a trend, what happens is, in an ideal world scenario, is that, say for example, we are in a trend, then price traded lower, then we want price to retrace. We always want it to retrace this towards this previous support turn resistance. Then it trades lower once more, and it retrace. That's this previous support now turn resistance, and retrace lower once more. And you get the gist, right? Retest it and trade lower once more. And this is an ideal world situation, right? But the thing about trading is that it is seldom close to the ideal world. So what moving average can do is to act as potential dynamic support and resistance for you. In case there are times whereby price trades lower, then it retraces. It doesn't retrace high enough to this particular area where you're looking at, and then it trades lower once more. Then you retrace a little bit, and then have another sell down again. So the thing is, this is what would usually happen in a real world scenario. Price will not come to the exact level you want. That is why, or I would say, this is how you can actually use the moving average to act as potential dynamic support and resistance. So looking at this chart, this is the chart of Euro Dollar daily chart, and you can see price is actually respecting the dynamic resistance as I've highlighted over here. This is actually a dynamic resistance, and it's actually made up of, again, the 20 and 50 period moving average. So you notice that price comes back towards this area, they trades lower, comes back once more, trades lower, came back in once more, and trades lower, came back in once more, trades lower. So the 20 and 50 can act as a dynamic resistance and support. So that's how it is in the trading market. You can actually use these tools to identify where are potential areas where price may bounce off by using them as anticipating that they will act as a dynamic support and resistance in the market. And once again, there's nothing special about the 2050. I use it because it fits me well, and that's about it. You can use the 25, the 55, or 60. I'm sure it will, at some point in time, also respect these areas, right? Nothing is certain in concrete. Nothing is 100%. But if you can make more money when you win compared to then when you lose, then overall the long run, you will be profitable, right? And that's trend following. I basically win about 30% of the time, but when I win, I make sure I win more than I lose. So this is how the math will work out in the long run. So this is the aspect about moving average on how it can act as dynamic support and resistance. So up next, let's understand how moving average can tell you about a relative strength of a particular currency. Let's say for example, you are a forex trader and you're currently bullish on the US dollar. So you want to long the US dollar. But the thing in forex is this: if you want to long the US dollar, you need to short it with an opposing currency, and you have quite a basket of currency you can choose. You can choose the Aussie dollar, the pound dollar, the euro dollar, the Canadian dollar, the yen. So you have a few currencies that you can match it against the US dollar. And the thing is this: say for example you are bullish on the US dollar. Naturally you want to short it against, you want to long the US dollar and you want to short the opposing currency. You want to short the weakest currency as possible. Am I right? Because by shorting the weakest currency, what you have is a very nice trend, because one is very strong and one is very weak. So you get a very nice trend. So the thing is this: how do you find this weak currency that you want to short against the US dollar? Meaning you want to long the US dollar and you want to short the weakest currency. So what you can do is understand relative strength. You can simply understand relative strength using moving averages on a chart. Say for example, right now I'm bullish on the US dollar and I look at the pound dollar weekly chart. I notice that there's a strong rally on pound all the way up, testing this 50 EMA, then it retraces down lower. So there is some strength in the pound over the last, I would say, 6-7 weeks, because we saw this very strong rally towards the 50 EMA over here. So that's a little information for you guys. So now let's look at another chart, say the Aussie dollar. There's something clearly very different on this chart. This is the Aussie dollar weekly chart, and you notice that price couldn't even test the 50 EMA over here. Whereas you saw earlier on the pound dollar, price did manage to test the 50 EMA. So what is this telling you based on comparison between the pound dollar and the Aussie dollar? What is this telling you? This is actually telling you that the Aussie dollar is clearly much weaker compared to the pound dollar. Just based on the moving averages, based on how price reaches the moving averages, you can actually understand which is actually the stronger or the weaker currency. So clearly in this case, Aussie dollar is the weaker one, because it failed to even touch the 50 EMA over here. Couldn't even rally that high before, trading down lower once more over here. So it's telling me that if I want to long the US dollar, it would be wise to pick the US dollar against the Aussie dollar compared to US dollar against the pound dollar, because you want to be shorting the weakest currency, or I would say one of the weakest, rather than shorting the stronger one, because it doesn't make sense, right? When you want to short, pick the weaker one, because it will tend to go further in your favor. And in this particular scenario, Aussie dollar is definitely I won't want to use the word definitely, but based on the moving average, based on the charts, it's clearly telling me that the weaker currency pair to short is actually the Aussie dollar. So that's all I have for you boys and girls this week. So let's do a recap. First thing first, we talk about how the moving average can tell you the direction of the trend. And I do it by using the 20 and the 50 period moving average. And once again, I repeat, there's nothing magical about these two numbers. Secondly, we talk about how moving average can act as a dynamic support and resistance. Because in an ideal world scenario, we always want price to, come back to previous support, turn resistance, and bounce off. But sometimes, in a not so ideal world scenario, price doesn't do that, and this is where your moving average can act as a dynamic support and resistance to identify areas where price may potentially bounce off. And last but not least, we talk about relative strength. So say, for example, you can use it on the Forex market earlier. For example, you're bullish on the US dollar and you want to short it. You want to long the US dollar and short the weakest currency. So how do you identify the weakest currency? You can use relative strength by using the moving average on the charts earlier that I've shown you. So these are some tidbits for you boys and girls out there. Hope you all find it useful. If you have any comments, feel free to leave it below. With that, I wish you guys good luck and good trading. I'll talk to you soon.